Welcome back to this series on what you need to know to get started in the stock market. And today I want to have a look at some of the traditional myths that have been around the industry for a long, long time to do with investing. And I want to explode some of those myths because they really don't hold water when you look at the actual facts. The first one that I want to look at is that diversification by market cap is, or the size of the company, is the best way to manage risk. Now, that's really a good way to guarantee yourself mediocrity, in my view, because it means that you end up owning some good stocks, but you also end up owning some pretty also ran stocks as well. So you end up with real mediocre performance by doing it that way. And I don't believe that you actually manage risk all that well by adopting that method. And the second myth that I want to explode is that higher returns necessarily mean higher risk. And again, that's not the case. There's a small number of stocks that are the best performers on our market, and they consistently outperform the average by a long, long way. And to my mind, you're not taking any more risk by investing in those sort of shares. So let's have a look at the traditional diversification technique. The way I look at it is, why would I want to own my 15th or 20th best investment when I can own more of my top 3 or 4 or 5 stocks? That just seems to make more sense to me. And there's been a lot of big household name companies that have gone completely bust over the years. And just a few of them to highlight it. HIH Insurance was our second biggest insurance company, and it completely failed. Babcock and Brown was a very large investment bank, similar to Macquarie Bank, and it disappeared as well in the GFC. And of course, Centro Properties, which was one of the largest shopping centre owners in the country, all but disappeared. So being large and being an accepted household name does not give you any guarantees of anything. So let's look at the second aspect, and that's also that there are plenty of stocks that are just poor performers. They might be in the top 20 or the top 50 stocks on the market, but they just don't build shareholder wealth over time, or they do it very slowly. So let's have a look at a few examples. First of all, BHP. So I'm looking at this since 2007, so we're looking at about 5 years of performance. And BHP has really returned basically zero to shareholders. It's in fact minus 1% per annum since 2007. Now, yes, they've provided a dividend, but there's been some capital loss as well. Now, CBA has performed well. In fact, the major banks have performed well of late, and I just want to look at the two majors. And these numbers are obviously looking a lot better because they've had a huge surge in the last 12 months. So Commonwealth Bank, including their dividends and their capital gain, have given you a return of 17% per annum over the last 5 years. And Westpac, pretty similar kind of performance, around about 14% per annum over that time. But the question is, they look very fully valued or even overvalued at this point in time, and that's certainly probably not consistent with their really long-term performance. Telstra has returned an average of 10% per annum over the last 5 years, but that's only after the share price doubled in the last 12 months. Prior to that, the returns were negative. AMP has essentially been a flat return to shareholders over the last 5 years. So a lot of people think a stock like AMP would naturally be a good performer, but look, it's not really the case. QBE, which was regarded 5 years ago as probably the best insurance company in the world, has actually given shareholders a negative return over the last 5 years. And that's because it lost a lot of its capital performance. And Macquarie Bank, barely a positive return each year over the last 5 years. And finally, Wesfarmers. Again, a really good solid company. They're actually a very solid company. And 8% per annum is not a bad return. But my message is that you can do so much better than these sort of returns. So let's have a look at what it's like investing in some of the best that the Australian stock market has to offer. Let's have a look at ARB Corporation, which makes four-wheel drive equipment. They're not very well known, but they're probably the best performer on the Australian market over the last 10 years in terms of the level of their performance and also the consistency of that performance. They've created a 32% per annum return for shareholders during that period of time. And these numbers are based over the last 5 years. Another company called Macmillan Shakespeare has provided shareholders with a 45% return per annum. iiNet, which is our third largest internet company now, a 35% per annum return to shareholders. Thorn Group, 32% per annum. The Retail Food Group, 32% per annum. And M2 Telecommunications, which is our fourth biggest communications company, a whopping 68% per annum return over the last 5 years. So when you look at those returns, it really does beg the question, which would you rather own? Would you rather own the top 20, or would you rather own some of the best performing and most consistent financial performers on the Australian market? It's a bit of a no-brainer consideration, really. Now, what is needed to achieve this sort of above average returns? I'm going to be covering that in a future video, specifically the sort of elements that you look for. But there's always a few high quality businesses out there which become available more cheaply. So it's a matter of knowing what we want and then just jumping on board when the price is right. Now, a few basic rules to think about. And everything that you need to do in the stock market, you need to be organized, you need to have a process, and you need to be able to monitor it. So the first step is developing a pool of great businesses, because long term, the share price is going to track the long-term business performance. The second thing is you need to buy them when they're cheap, because quite often these great businesses can be overvalued. So you need to just know what's a reasonable price and be ready to jump in at that point in time. And ideally, when some kind of shorter term issue causes the price to drop suddenly. And a really great example of this is a stock called Codan. Now I'll just flick over and have a look at that price chart. Now Codan is a stock that, or a business, amongst other things, it makes metal detectors, and people use metal detectors to search for gold. Now when the recent price of gold crashed, the price of Codan, as you can see, dropped from around $3.60, and it dropped all the way down to $2.55, and it did that in about 3 or 4 days. And that was because there was just an irrational selling off of the stock because people made an association with the price of gold, when in actual fact that's really a pretty irrational way to look at things. And then the stock immediately rebounded from $2.55 to about $3.50 in 2 days. So you can see that sometimes the irrational behavior of the market just creates great opportunities for us. Now, the important thing is to remain clear and focused on what you're doing in the investing sphere. And most investors need some assistance with this, because let's face it, we all get busy, we have family considerations, and the stock market is probably not your first priority in terms of time allocation. So it's really important to understand that, as with anything, if you can tap into the resources of an expert, then it can be enormously helpful to your investing success. And the second thing is that you need to understand that this is a very dynamic process. You can't just buy some stocks and then wipe your hands and think that that's the end of it and you can just set and forget them for the next 5 to 10 years. That's absolutely not the case. And JB Hi-Fi is a great example of that. So let's have a look at that price chart. Now, JB Hi-Fi is obviously a very well-known stock, and we're looking here at about 5 or 6 years worth of price history. If we go back to the lows in 2008 after the GFC, the stock was trading down around about $8. It then shot up in the space of less than a year. It shot up to $23. So it basically tripled in price in the space of a year. We then saw the price collapse again from 23 all the way down to 8, so back where it had been basically 4 years earlier, and it's only been recently that it started to recover again. So This is fairly typical of what happens with stocks. And in a later video, I'll show you an even more graphic example of how this plays out. So it's really not a case of just buying a good quality stock and then expecting it just to do its thing for the next 5 years. It's just not the case. It's something you do need to stay on top of. Now, the price of a stock most times does not reflect the value of the business or the worth of the business. It's generally overvalued or undervalued. And it's not that much of the time that it's actually roughly equivalent to the fair value of the company. So why should, as an investor, should you react as if the price does actually represent the value? So just because the price of a stock rises doesn't mean that it's necessarily one you want to own. And equally, if the price falls suddenly, it's not necessarily a sign that there's anything wrong with the business and you should get out of it. So you need to distinguish very clearly between the value of a business and what the price is actually telling you at any point in time. And often they're not the same thing. Now, in some future videos, I'm going to identify how to actually select the best of the best kind of stocks. There's a clear-cut formula for doing this. It's relatively straightforward. It does require a lot of work though, and that's something that you can use experts to assist you with. And we're also going to look at how to trade shares profitably. So we've been looking at how to invest for the longer term, but I want to take a look at some of the key things about trading shares profitably. And we're going to look at something called phase analysis and also some simple indicators that work really well in the market. And finally, some high probability entry patterns. So they're all in coming videos. See you again soon. Cheers.